Welcome back, everyone. This is the Mortgage Sensei here. Today, what we're going to talk about is the path to home ownership. The path to home ownership. Okay. This is going to be somewhat I'm going to try to condense it as much as I possibly can. Talk about, what you should expect, what you should work towards, what you should be prepared for. That way you can go from a point of watching this video, taking those actionable steps, and then getting to the point where, you find a house, you go on a contract, go through formal underwriting, close, and now you're a homeowner. So first things first, let's go ahead and get you up here. So this is you, okay? All right. And the first thing that you're looking to do, now, of course, you've watched maybe some of my videos here. You probably did some research. You probably already talked to some family members or something like that. And now you're looking for, what do I need to do next? Or maybe you haven't researched programs or research lenders or anything along those lines. Nelson, what do I need to do first? The first thing you got to do is go and get prepared, right? So let's go ahead and draw a line, and then we're going to say prepare. Okay? We're going to say prepare. Now, when we're talking about getting prepared, we're going to enclose in this credit. We're going to enclose in this income. And then we're going to enclose in this funds. Okay? Credit, income, and funds. Now, the reason why I'm saying credit, income, and funds, when it comes to the basic mechanics of any loan, the number one factor that we have to go about figuring out as far as a mortgage loan originator, a bank, a lender, a broker, we all abide by the same lending guidelines as far as our foundation. And the number one thing that we have to do is show your ability to repay a loan. And your number two is your ability to acquire the loan, right? Those are totally two different things. So when we talk about your ability to repay the loan, we're specifically looking at your credit and your income. The reason we're looking at your credit, this is telling us your past payment history with other creditors. The reason we're looking at your income when it comes to your ability to repay the loan is, do you have stable income right now to make these payments going forward in the future? Now, we're going to normally take into account your last 2 years in order to justify your ability to pay for a mortgage for the next 15, 30, years in the future. Now, the reason why I put funds there, funds has to do with your ability to acquire the property or to take possession at closing. That can be your down payment, your closing costs. Maybe you have to have some reserve set aside in order to show hardship ability in case something comes up, right? Just to name a few there. So this is really where you want to start at. Now, like I always say, when it comes to credit, your sweet spot is a 640 credit score. Can you have a lower credit score? Yes, but don't be surprised if you start having more stipulations, right? Or more hoops to jump through, more hurdles to jump over, right? Income. Income is going to be relative to your home purchase or what's going on, right? Now, when it comes to income, you work where you work, you make what you make, right? When we're talking about debt, when we talk about income, we're more specific with debt to income, right? Debt to income. Now, your debt to income ratio is basically this, and I have another video in regards to it, but translate debt to income ratio into cash flow, right? How much liquidity or how much money am I coming in? So if I go to work and I work and I make, let's say I make $10,000 a month, right? I'm working, I make $10,000 a month, and my debt is $9,000 a month. That means I got $1,000 left over. Am I going to be able to get a house? Well, it depends on what those debts are, but you're making it tough for yourself. Well, whereas, okay, I got $10,000 a month in debt, and I got $10,000 in income, and my debt is $4,000. Well, I got $6,000 worth of cash flow coming through, right? Does that put me in a better position to afford the home or show my ability to repay the home? Yes, it does. So when it comes to your debt to income ratio, you can only affect it one or two ways. Either A, you increase your income, right? Then maybe that's a co-signer, maybe you get a new job, or something along those lines where we can use the new qualifying income, or you lower your debts. I mean, maybe you're paying off some debts, maybe you get less house to qualify for. Again, we're talking about the difference between renting and home ownership. Now, renting may make sense for you, right? If you're traveling a lot, Nelson, I'm trying to do my thing, YOLO it out. But if you're looking to get stable somewhere, build some generational wealth, and get on that path that's for you and your family, then home ownership is the route to go. Now, when we talk about funds, right? Again, funds, like I said, we're talking about down payment, closing costs, and reserves, right? This is how much cash do you have set in the bank, right? Now, don't forget that you have your acquisition costs, or the money that I need to get the property, right? And then also you have your money for hardship, your reserves, but don't ever forget your moving costs, right? I'm sure if you buy a new home, you might want to get some new furniture, right? You might want to throw a party, right? You might need to take into account the transition costs of, okay, I need to take time off from work in order for me to get all my stuff to the new place, or pay for movers or anything along those lines. So buffer yourself and get prepared for that. And last but not least, in case something goes sideways, right? I hate to put it out there, but let's be real, people. In case something goes sideways, meaning what? Well, I got pre-approved 2 months ago. I've been looking for a house for 2 months, and the market shot up, right? Now the interest rate that I was going to get, is not there anymore, or it's there, but now I'm not getting as much lender credit on, paying more discount points. So cushion, that's all we're talking about, liquidity, cushion, all right? So you're preparing with your credit, your income, and your funds, right? Again, when it comes to income, we're looking for the last 2 years. Are you stable for the last 2 years when it comes to income? Or did you just start a new business a couple months ago, or 6 months ago, right? Are you rapidly changing jobs over the last 1 to 2 years? Have you changed employers, 4 more times, right? We're looking for the stability in your income. Now, you have first, so now you have prepared. You got your credit right. You got your income looking good. You got your funds set aside. You watched Nelson's video in regards to credit, debt to income ratio, assets and reserve, right? Now what, Nelson? What's the next step I need to go from this point? Well, you can go one or two ways, right? But your next point really is to get qualified. Get qualified, right? Now, what does that look like? Well, when we're talking about getting qualified, you're really just getting with a representative that is a loan originator. Okay? A loan originator, right? Now, a loan originator is, this is the actual individual, a person like myself, right? That works with a bank, works with a lender, works with a mortgage broker, and they'll take your information. So you got your credit, your income, your funds. You gather all your supporting documentation, your driver's license, your last 30 days of pay stubs, last 2 years of W-2s, maybe last 2 years of 1099s and tax returns, your last 60 days of bank statements, your most recent retirement statement. Maybe you got a child support, you got that, divorce agreement, you got the decree from that, maybe your bankruptcy papers, whatever it is, right? You gathered all your documentation together, you got your credit, you got your income, you got your funds, and now you need to go get qualified. Then you go right to a loan originator, okay? Now, what this loan originator is going to do is basically start the application. It's not the official application because we don't have a subject property, or you have found the actual home. Here's the address, to the home. I'm under contract. I'm looking to buy. But a good loan officer should be able to preemptively structure the loan in a way based off of the area in which you want to buy, right? We can determine the property taxes, determine the homeowner's insurance, right? Structure the loan according to the loan program, conventional, FHA, VA, USDA, any other, non-traditional type of programs, right? Review your supporting documentation and have the conversation with you. right? This is what a professional loan officer should be doing for you. If they're not doing that at the bare minimum, then watch out, okay? Now, so you go to the loan originator, you get qualified, right? Now, when you go to the loan originator, you are presenting, supporting docs, okay? So, like I said, you're presenting your supporting docs. So that means you've done all this work over here, right? You may not have, you got to go in the filing cabinet or whatever. You got to pull out all your whatever, your documentation, but you're going to the loan originator to get qualified. Now, the loan originator will give you a list of stuff that you need to get. You go and grab that stuff. You send it to the loan originator, right? From there, the loan originator will then finalize loan structure. Okay. Now, the reason why I say the loan originator finalizes the loan structuring, right, is we don't have the subject property, so we're not done, right? But we should be at least knowing, if where we at with credit, based off of how much income you got, based off of how much money you have available or that you can get, in order to close. We should start finalizing what type of loan program that we're going to go with. So let's put that off to the side here. Loan program. Because that's really what we're talking about here. We're finalizing what type of loan program are we going to go with, Nelson. And that's exactly what we're looking to do here. That's what the loan originator do. We get your supporting documents. We do the preliminary application. We're calculating your income. We're seeing, okay, where is the money going to come from? And then we say, okay, we're going to go with a conventional loan or FHA loan or a VA loan or whatever the case may be. And then from there, once we finalize the loan program, what you should be receiving at this point in time is your, I'll call it a fee worksheet. Okay. But the reason why you will get this is that we're starting to talk about, okay, how much is this going to cost me? Okay. Now, from this point, we're going to circle back around. All right. Now, up to this point right here, this is all pre-qualification. Okay. For the loan originator, boom, 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 all the way here, get you a free worksheet. All you're talking about at this point in time is a pre-qualification. Okay. A pre-qualification means that the loan originator has structured a loan, right? Got the supporting documents, poor credit, or at least should have, right? Put the loan together. They maybe went the additional step of doing a automatic underwriting, right? Which is just an electronic underwriting through the system with Fannie Mae, Freddie Mac, FHA, VA, GUS for USDA. But there's no underwriter involved. Okay, there's no underwriter involved, or the official person who reviews the file, crosses the T's, dots the I's, make sure everything matches the guidelines, right? In order to say, yeah, this is clear for X amount of days until we get to closing, right? So what you want to happen is right here, get underwriter involved. Okay. Now, the challenge here is that not every lender or loan originator or company out there will go about of getting a pre-approval. Now, there's a lot of them out there, but we're talking about a true pre-approval. Again, a true pre-approval means I have found my loan originator, the bank, the lender, whoever you want, Mortgage Sensei, okay? I have sent Mortgage Sensei my supporting documentation, right? Credit's been ordered, income documents provided, asset documents provided, liability documents have been provided, any court orders, civil documents have been provided, right? Me and Mortgage Sensei, we finalized the loan. Okay, Mortgage Sensei put together, say, okay, based off of your financial situation, this is the loan program that's going to allow you to buy the most house, or this is the loan program that fits what you want to do or that you can do. Okay, great. Get a fee worksheet. Now we're talking about payments, rate. We're talking about, out-of-pocket costs. What I'm going to do to come up with the money in order to get the loan done. Okay. All right, you got that. Great. Then we formally register and submit the file to the underwriter. Okay. Now, when you give the file to the underwriter, there's always a delay. There's always a delay. And the delay can be anywhere between 1 to 5 days, right? And I say 1 to 5 days because it depends on the lender. But a true physical underwriter looking at your file, don't be surprised if it's somewhere between 3 to 5 days. 3 to 5 days for them to formally review, say, okay, this is good, this is good, this is good, whatever, and then they're going to issue out a conditional acceptance or conditional approval, or along those lines. Now, the conditional approval normally comes out with the basic. First thing, you got to find a house. Probably got to get an appraisal. Probably got to order title, or you'll have to order title work. You have to order insurance for the property. It might be some specific state or program documents, and they need to be signed by the realtor or the seller. That's standard stuff, right? But the biggest thing that we're looking for are what are called credit conditions. Okay, credit conditions. Now, the reason why we're picking out specifically credit conditions, because that's stuff that we can get right now. We don't have to wait for you to find a house and go on the contract and then start working on credit conditions. Let me give you an example. So you send in your income documents, right? Pay stubs, W-2s, maybe some tax returns, okay? And then the file submitted to the underwriter, boom, underwriter sends out credit condition in regards to income. We need a work verification of employment. We can go ahead and go and get that right now. We can call up the employer, whoever's in charge of payroll or completing the work verification form, have them fill that out, send it in. Maybe the credit condition is, okay, complete this letter of explanation in regards to credit or in regards to liabilities or anything along those lines. Go ahead and address that right now. What you're looking to do is to eliminate as many conditions as you can up front before you go on the contract. This is what allows people to close within 7 to 15 days, right? You ever seen those posts or whatever out there? Oh, I went on a contract and it was like, right, we were done in like a week or two. It was amazing. Well, that's all about the prep work, right? Because once you submit that file to the underwriter, the longer that condition list or the shorter that condition list greatly affects how long it's going to take in order for you to close on your home. So remember, credit conditions, we want to get that knocked out. We want to get as many of those income, credit, funds, civil, liabilities, whatever documentation, right? We want to get all of that knocked out as much as possible. That way, once we go on the contract, all that's left over is presenting a fully executed contract, ordering the appraisal, ordering the title, ordering the homeowner's insurance, maybe getting some updated, documents, because we can't do certain things until we go on the contract. But maybe getting some updated disclosures. Maybe you got to send an updated pay stub, updated bank statements, because we roll to another week or roll to another month, something like that. But you want to reduce and minimize that list as much as possible before you go on the contract. Okay, so we got the credit conditions knocked out, right? All right, now what, Nelson? Well, once the file sees the underwriter and the credit conditions come out, at the same exact time, you should be receiving your pre-approval letter. Okay, pre-approval letter. Now, the pre-approval letter is basically saying, I, the underwriter, not Mortgage Sensei, but I, the underwriter in this case, have reviewed your credit, your supporting income, your supporting funds, the structuring of the loan based off of the projected area that you want to buy, and based off of that information, we are conditionally approved, provided that you give right? So now you got a pre-approval letter, okay? Now, once you get that pre-approval letter, you need to ask this question. You need to be aware of what's going on. Is my rate locked? Is my rate locked? Okay, you have to know that, right? Normally it's disclosed in a pre-approval, or there's a conversation that's had, or something along those lines, right? But not all lenders will lock in your rate until you go under contract, right? And even if they do lock in your rate before you go on the contract, you run the risk of you not closing in enough time of the lock expiring. Give me an example. So you go to the underwriter, you get your credit conditions, you got your pre-approval letter. The loan originator locks in that pre-approved interest rate for 60 days, right? Maybe 90 days. But then it takes you 75 days to find a house. And now you only have 15 days left on that lock. Oh, Nelson, you said you can get it closed in 15 days. Yes, it can happen, but you leave yourself no room for error. What if the seller goes out of town? What if the title company can't get you back the documentation quickly? What if the insurance company says, oh, we're not going to insure this property. Now you got to go find another insurance company. What if the appraiser, right, says, I can get that done in 15 days. I am slammed. It's going to take me 17 days, right? You could blow your lock. That costs you more money, you know? So you want to know, is your rate locked? But the moment you get that pre-approval letter, you got to find a house fast, especially when the interest rates are going up. Now, when interest rates are going down, don't worry about whether your rate is locked or not, because you can ride that wave down to the last moment, lock in your rate and get a lower rate. But if the interest rates are inclining like they are right now, as of call it June 21st of 2022, interest rates have been inclining at a rapid pace since the start of the year, then you don't want to lock in sooner than you can, but you know, be cautious because your rate might not be locked in. And I see that a lot with clients today. So, okay, so you got your pre-approval letter. Is your rate locked? From here, next thing you're doing is, if you don't have one, you get a realtor, right? And when you get your realtor, you're doing a home search. Okay. All right. So you got your pre-approval letter, right? Then you bring in your realtor. Or maybe you already found a realtor. You already know exactly who you're going to work with. Okay. But when you're in a market like we're in right now, where there's more buyers than there are sellers, okay, or there's more demand than there is supply of homes or inventory, you want to walk into that situation where your loan looks like you got it together, right? You've done the due diligence, you got all your ducks in a row, right? You're qualifying, right? Because there's nothing worse than finding the house that you want to buy, and you lose out on the offer to a cash buyer, because that's how it happens a lot, especially if the home price is $500,000 or less. You know, half of those homes getting bought by Wall Street. So you're competing against big money. So you want to enter into that situation. Hey, you know, I've done my due diligence. I'm ready to go. Look, here's a pre-approval letter, and then the loan originator can take additional steps to assist you at that point in time. Maybe you get an FHA loan, a VA loan, USDA loan. Not only are you competing with cash offers, but now you're competing with conventional loans, right? Because the seller gets to choose, you know, I don't want to go with that type of lender. I don't want to go with that type of loan, right? It may be unethical in your eyes, but it's totally legal where the seller can decide who they want to sell their home to, right? So, especially when it comes to presenting finances. Anything else outside of that, race, you know, gender, you know, whatever your belief system is, and so on and so forth, that's on the illegal side. But when it comes to financing or your ability to acquire this property from me as a seller, right, I need to know you got the money and you can actually get this done. That's really what they're looking at. Okay, so you're working with your realtor. You're searching for a home. All right, Nelson, I found the home. Okay, next thing is you go under contract. So this is your purchase contract. The realtor is going to write that up for you, and you're going to give your earnest money deposit. We call it EMD, but your earnest money deposit. Okay, so you're out there with your realtor. You're driving around. You're meeting them at the location, whatever. You know, maybe you're buying it sight unseen. Meaning you're looking on online, and this realtor is phenomenal. They'll go to the property for you with a camera, live or Facebook live, or FaceTime it with you and walk through it, and you know, you buy the property, right? So you go on the contract, you present your earnest money. Your earnest money is your monetary binding aspect of the contract that makes it real, right? It can be anywhere between, you know, maybe a couple $100, maybe 3% of the purchase price, whatever your realtor negotiates with the listing agent. But at this point, you're under contract and you got your earnest money. From there, we come back to the loan originator, right? Now, at this point in time, it doesn't mean you don't have to talk to your loan originator, right? What I'm saying at this point, this is really where the loan originator is going to get heavily back involved, or they're going to be the forefront, right? Well, but between the pre-approval and going under contract, your realtor's at the forefront, right? They're the partner involved in the transaction that's taking, you know, the lead on this to help you move to the next step. Now you're under contract. Now the loan originator or the lender, they're the ones that need to be taking the lead in order to get you to the closing table. Okay. Now, so you got your contract, got your earnest money deposit, you send in copies of that, so on and so forth, right? Comes to the loan originator. At that point, the loan originator is doing the following, or again, should be doing the following. So you should be, or not should be, but you can then make sure the loan originator is doing what they should be doing, or the lender is doing what they should be doing. Okay. So, so the contract comes in. The first thing we're doing is initial disclosures. Okay. The initial disclosure is going to be your formal loan application. It's going to be your loan estimate, right? And all the other documents, your state and federal and loan program documents. But the biggest two we're talking about is your loan application, your uniform residential loan application, and your loan estimate, right? Now, remember, this is the estimate. A lot of times what I personally do is I get the estimate out as quickly as possible based off of a default, right? Default means, you know, the actual closing attorney or the actual closing company maybe haven't provided their title docs, right? Because sometimes it takes a week or 2 weeks, right? Sometimes 3 weeks if they're really slam, but we don't want to be sitting around twiddling our thumbs. So what I do is I default and I'll go with internet generated, you know, auto generated type of title provider and put the title docs in there or the figures in there and the issue at the LE so we can keep it moving, right? But the loan estimate should be about in the ballpark of what it's going to be. So make sure you review that. Please check out my loan estimate video that I created. I'll put a link in the description for you as well. That way you can take a look at that, along with the uniform residential loan application, how to get that completed. But basically, you got your initial disclosures out. From there, once you sign your initial disclosures, we are looking to order the appraisal, right? Order the appraisal. Now, you know, you might want to get the appraisal order on the rush, depending on how much time you have in order to get the loan closed. But we're going to order the appraisal. We're going to order title work. Now, this is different from the auto default. The title work is based off of whoever the closing attorney or the title company, settlement agent, whatever, that's actually on the contract. On the contract, it states, okay, this person or this company is going to hold closing for us, right? So when we get that contract in, your loan originator, the lender, whoever, right, is reaching out to that company and placing the title order, right? But we don't want to wait a week, 2 weeks, or whatever for that title order to come in. So we go ahead and disclose. At least that's how we do it, and that's how we get our deals closed fast. So initial disclose, appraisal order, title work, and then we also need homeowner insurance. Okay, so you know, at minimum, you're going out there and you're getting an insurance quote, and you're providing an insurance quote with the representative, and then the lender is reaching out to this person in order to get the mortgagee clause and the mortgage docs for the insurance. And then last but not least, we are doing underwriting submission. Underwriting submission. I just put underwriting stuff. Underwriting submission, right? So what does that mean? So we have the contract in, maybe we got some updated documents or anything along those lines, right? We structured a loan, initial disclosure going out, whatever. But we want to get the file back to the underwriter as quickly as possible, unless we did a phenomenal pre-approval and you know it's nothing needed. But in most cases, you're getting the file back to the underwriter as quickly as possible. So all of this is happening up front, or should be happening up front within days, literally 1 or 2, maybe 3 days max of your contract coming to your loan originator or your lender, right? We're doing all of this, or at least that's what I do. Again, so all of this is happening, right? Now, from here, okay, we're gonna talk about each one a little bit and kind of explain what's going on, right? So I'm gonna step off from the track here, because it kind of just branches out, from this point, because there's a lot of stuff happening at the same time. So your initial disclosures, okay? Your initial disclosure should be going out within 3 business days of the actual application being completed. You and maybe whoever else is going on along with you, but you're going to be normally electronically signing these disclosures. It's imperative that you use the email that you're going to use through the whole process. An email that you're going to look at often and be very attentive to, okay? But you're going to sign that, and then when you get your redisclosures or whatever notifications, it's going to that email. The appraisal. Once you have electronically signed your disclosures, at that point in time, we're now able to order the appraisal. The reason being is that inside of the initial disclosures, there's a form that's called the ITP, intent to proceed. Until you sign that form, we cannot order the appraisal. So it's important that you sign your initial disclosures as soon as possible so that we can order the appraisal. Once the appraisal order is made, again, the appraisal order goes through a third-party appraisal management company. The lender, the bank, the broker, we do not own or control or dictate the appraisal management company. We make requests, okay? We don't make demands, we make requests, okay? So we make a request to the AMC in which they will send you a payment link. Normally you pay that with credit card or debit card, but you will make that payment. Once the payment has been received to the AMC then goes out and contacts a third party. So they don't work for the AMC, but a third party contractor who is the appraiser, right? The appraisers in the area looks at your order and say, oh, I'll take it, or whoever's available says, I'll take it. Now, disclaimer, they may say, I'll take it, but it's going to cost you more, right? So be on the lookout. That may happen if you're in an area where the demand for the appraisers, or again, everything is supply and demand, but the demand for the appraiser exceeds the amount of appraisers that's available, meaning there's not enough appraisers in the area that can do the work. So they may charge you more, or they may take longer, okay? But long story short, the appraiser accepts the order, and then the appraiser is going to give us 2 important dates. The first date, they're going to tell us when the inspection date is. This is the date the appraiser actually goes to the home to inspect the property, right? Number 2, they're going to give you the completion date. This is the date when the appraisal report, they will complete it, and it then goes to the AMC first. All right, so the appraiser collects the order or takes the order. They say, okay, the inspection is going to be completed on this date. The appraiser goes out on the inspection date, inspects the property, right? They get paid because they don't get paid until they go out and inspect the property. So they go out and inspect the property, they get paid, they'll get the comps, the comparables, and so on and so forth. They generate the final appraisal, and then they present it on the completion date to the AMC. Once the AMC has received the appraisal report from the appraiser, it then goes to QC or quality control within the AMC. It normally takes a couple hours or so. Then the AMC sends the appraisal report to the lender, and then it goes through quality control with the lender. And then the lender says, yes, this looks good. And then a copy goes out to the originator, a copy goes out to you, or the lender, bank, broker says, oh no, y'all missed some stuff, right? You're missing pictures, you're missing words, you didn't do a good job. Sends it back to the appraiser, right? Or sends the request to the AMC informs the appraiser makes the changes that's required, sends it in, and comes back to the lender, back to QC to make sure everything's right. So there's a little process that why it's ordered up front. But the appraisal report comes in, and then you go about the appraisal report, whether we're clean or whether there's subject to conditions, meaning there's repairs that's needed, or maybe the value came in higher than expected, or the value came in lower than expected. But you cross that bridge once you get there. All right. Now let's talk about title work. So again, we got the contract in, right? the initial disclosures go out. Now, you may have not signed the initial disclosures, but the title work can be ordered with the title company. We provide them with the loan number. Normally, we just give them like the residential loan application or the LE in the contract, and give them specific stuff they always ask for as far as the title company. And then they generate title work. Some title companies can knock it out in a couple of hours. Some title companies might take a week or 2 or 3, right? But whatever it is, the title company goes about putting together the preliminary CD or the preliminary closing disclosure, which itemizes all of the costs that it takes them in order to do the work, and then provide that along with other required title documents. I'm going to shorten it up again for the sake of this video. All right, we get that title docs back, and then title companies kind of somewhat on ice until we get the clear to close. After that, homeowners insurance. So you go out there and you get an insurance quote. In my case, I work with a lot of insurance providers, maybe some insurance brokers and so on and so forth, but we get your insurance quote, okay? The quote is to make sure that the loan still works, all right? The premium, how much you pay annually per month type situation. But we reach out to the insurance agent, let them know that we're looking for them to open the policy or bind the policy, give them all the mortgagee clause information or the lender information as far as who will get paid out in case something goes wrong and there's still a lien on the property. And then they provide the insurance docs, right? We get that over to the underwriter, right? Now, while all this is being done, the underwriter is taking a look at the file, right? Again, maybe we did an excellent job up here, so we're just waiting on title docs and homeowners insurance, get your initial disclosure done, maybe get some updated pay stubs, get it back to the underwriter, right? Whatever the case may be, you got to go back to the underwriter, all right? Now, the underwriter reviews it. All this is happening, and then the underwriter reviews it, and then you may or may not, but you may have what we call PTD conditions. PTD conditions, or prior to docs conditions, right? Now, prior to docs means that, okay, if you meet or get me these conditions, get me these items, right? Then I will allow your file to go to clear to close, all right? So you get your PTD conditions. Side note, you may get a PTA, prior to approval. Prior to approval means either A, the loan officer didn't do a good job restructuring your loan, or B, something about your financial situation has changed, meaning that maybe you changed job, maybe you didn't continue to work all the 40 hours that you make, so now you have varying hours, right? You took time off, you didn't use paid time off, whatever the case may be. Maybe the appraisal report came in less, and now the home didn't appraise out. There's a lot of reasons where something can change for prior to approval. But again, this is where your loan originator comes in right here, prior to approval, right? Any type of prior to approval, your loan originator kind of come in with the Superman cape and put it together and get it to work, right? Prior to documents, normally your processor can handle all of that. But again, it's just meeting the conditions, getting the necessary documents pulled together. Now, a proper pre-approval, most of these conditions will show up here at the credit conditions during the pre-approval stage, right? But again, if the loan originator or the lender or the bank didn't actually do a pre-approval, then they're all going to be listed right here, okay? So you got your prior to approval documents, you got your prior to documents, prior to docs conditions, right? Prior to approval conditions, right? But at the end of the day, we're clearing those conditions, or we're providing the necessary supporting documents in a satisfactory manner in order for the underwriter to look at it and says, okay, this meets guidelines, this meets regulation, this line item is clear, it's taken care of, okay? So we get all of that clear, right? And then after that, we get our famous words, CTC, right? In our world of the loan originator world, we absolutely love this number, or this phrase here. This is clear to close. That means the underwriter has cleared this loan for closing, all right? Now, at this point, it doesn't mean we're closing today, right? You got the clear close today at 2 p.m. In the afternoon. We're not closing today at 3 p.m. in the afternoon, 5 p.m. in the afternoon. Most title companies, they close at 5 p.m. Whatever time zone you live in. That's when they close. It may stay open late in order to accommodate, but most of them are closing at 5 p.m. Monday through Friday, right? Because normally, you know, Monday through Friday, the central banks in America, they close, right? The major banks where you can do the wiring of funds or whatever, they close on Saturdays and Sundays. And then depending on what time zone, normally they're done at like 5, 6, depending on what time zone or bank attachment that the title company used. But long story short, right? You got the clear to close, okay? Now, once you got the clear to close, the file then goes from the underwriter to the closer / funder. Okay. Now, let me highlight this. Most people forget about the closer and the funder. The customer, most of the time, customer don't even know this is the actual person that's involved in the process, number one, right? Because people just don't really talk about the closer and the funder. Number two, most loan originators completely forget about the closer and the funder. Number three, most realtors can completely forget or just don't know there is a closer and a funder. However, the title company normally knows who the closer and funder is, but the title company is under pressure by all parties in order to schedule a closing date. Now, why is the closer and funder is so important? The closer and the funder does two important roles in order for you to get to closing. The first role that the closer and funder does is this person sets the earliest closing date. Earliest closing date. Well, Nelson, the underwriter just cleared to close my file today. Should we close today? The underwriter just makes sure your file meets guidelines in order for the lender to fund on it. The closer handles all the logistics that's needed in order to get the final closing package sent from the lender to the settlement agent, title company, closing attorney, and the closer and the funder is the one who sends the money from the lender to the closing attorney, closing agent, you know, so on and so forth. And the closer and the funder is the person who balances the numbers with the closing attorney, the settlement, and the title company, right? So what does that mean? Well, the closer and the funder, they need time to do their job, right? That's ultimately what I'm saying. And normally they need anywhere between 24 to 48 hours, right? That's normally what they need. They might, now can they get it done in a couple of hours? Yes, but you can't expect them to just be sitting there twiddling their thumbs waiting on your situation, right? They're handling a whole bunch of other files because that's their job, right? So the closer and funder gets the file after the file is cleared to close by the underwriter, comes over to the closer and funder, right? Closer and funder balances the figures with the closing attorney or the title company. They transmit the final documents or send the documents that need to be printed out by the title company in order for you to come in and sign. And then they wire the money, or they send the money that funds the loan and pays the seller and the realtor or whatever and the title company, but they send the money to the title company so that once you finish signing or all parties finish signing, the money can be paid out to everybody, okay? All right, so the closer and funder, and then also last but not least, like I said, they set the earliest closing date. So the closer and funder says to the title company, okay, I got the clear to close. We can close as early as Tuesday. Anytime after Tuesday, we can close, right? Or whatever the date is. All right, so now the closer and funder has communicated to the title company. Okay? All right, now the money is sent to the title company. The closing docs is sent to the title company, right? The title company has has the supporting documentation, or has the closing disclosure, has the money in order to get it done. Then the title company is scheduling a time that works with all parties. Again, there's a lot of people that's involved that's coming to the closing table, right? It may be just you and the seller, but realtors, the actual closing agent got to be available. What the title company doing is coordinating everybody's availability, date and time, in order to make it to the closing table. So just because you're ready doesn't mean everybody else is ready. Or just because everybody else is ready, maybe it doesn't work with your schedule, right? This is where everything really starts to get worked out. Now, I always tell people, you don't start scheduling closing until at least you get the clear to close. But even if you get the clear to close, we want to know by the closer and the funder the earliest day that we can close. And then once we know the earliest date or the day that we can close, then you can start scheduling the time on that day or the next day in which you can close. Okay. So you go to the title company, right? Once that occurs, scheduling happens. So everybody's scheduled, and then closing takes place. Okay. Closing takes place. Now you go to the closing table. Your agent may be with you. The listing agent's there. The seller's there. The closing attorney, the loan originator may or may not be there, right? But at the end of the day, you get there, right? You bring your ID, you bring the money, you bring a pen, or normally they have a pen, but you normally have to bring some identification, and you got to make sure the money's there. Either you wire the money to the closing attorney, or you're bringing in a certified check or something like that. Okay. So you get to the closing table. Boom. You sign all your documentation. Okay. I'm done, Nelson, right? Nope. One last step. Okay. Once you finish all of the closing documents, right, the title company communicates back with the lender that they have met all of what is called PTL, right? PTL. Now, we talked about prior to approval. We talked about prior to documents. PTF is prior to funding conditions. This means that the lender or the closer and funder, when they communicated to the title company, in order for you to close, the closer and funder told the title company that I need X, Y, and Z done before we're done, right? So you got to go through A, B, C, so on and so forth. Well, before you finish the alphabet, you got to get through X, Y, Z. This is what we're talking about. X, Y, Z has to be done. Now, normally it's this document signed here, date here, initial here, get the money here, maybe get supporting statements, whatever the case may be, right? But prior to funding conditions are met, right? Now, once prior to funding conditions are met, the loan funds, and then you get keys. So the loan funds, so basically what happens is the money that the closer sent to the title company, closing occurred, everybody signed, they got all the supporting documentation required. Title company communicates back with the closer and funder, okay, I got all of this list, and provides it. Closer and funder then says to the title company, you are okay to go ahead and fund. The title company then funds the loan. So the seller gets paid, the agent gets paid, they get paid, right? And then you get your keys. They hand you the keys, okay? And now you're a homeowner. And that is, I know it's somewhat lengthy, but that is the most simplistic way to talk about the path to home ownership. I hope this video has been very educational. It empowers you, it encourages you through the process. It sets the right expectation, the right flow in order for you to get into a home and become a homeowner. If you enjoyed this video, please like, subscribe, hit the bell, check out the description below. I'm going to be providing some links to my published book through Amazon, How to Buy a Home with a Loan. Also links to my Facebook group, a link to my inquiry. So if you want to go ahead and get started and you want to get the process going up here, you want to go ahead and start getting qualified and talking to a loan originator, I'll love to help you through this home buying process and put you on my success wall here. But it's been a pleasure. If you rewind and take a look at this video again, share it with your friends, let people know. But at the end of the day, homeownership is for everybody, right? We all have a place to live. Let's own the home that we live. Mortgage Sensei out, and I'll see you on the other side of home ownership.